this week. Are we going to see in this earnings season that anything that would further support U.S. equities strength? And would that somehow help U.S. stock market broaden out beyond tech?
Hello there. Well, whatever it broadens out is a matter of conjecture, because clearly it's been the Mag 7 that have driven equities for quite some time. I would say a couple of things, actually. One is that the bar on earnings in this quarter has been relatively low. And because of that, what we're seeing is a relatively sort of positive season as far as earnings is concerned. What's more important, though, and I think this is a longer-term picture for the US markets, both in terms of equities but also in terms of fixed income, is actually the growth profile for the US. So let's not forget that we do have the third quarter GDP numbers coming up from the US this week. What it's going to show, in our opinion, is still the likelihood of a very strong economic growth picture for the US, which is notable because elsewhere in the world, we talk about China, we talk about Europe, we're not seeing such a strong economic picture. So add all of that together, and it's still very difficult from an equities perspective to look beyond the US at this particular point. And part of that is underlying consumption and growth within the economy. Part of that is this continued focus on the outperformance of the tech sector.
What about this global debt sell-off? I mean, some are saying that this is actually spreading to Japan and Europe. Traders are figuring out the Fed's next path here. This unwinding of their bets for an aggressive rate cuts. I mean, how long and how far is really the question looking at the treasuries?
Yeah, so I think it's very unlikely and also very unrealistic to expect that the Fed is necessarily going to move in increments of 50. That seemed to be a one-off move in September that was partly predicated on the fact that the Fed probably missed its opportunity to cut by 25 during the middle of the summer. So from here, I think the Fed has given sufficient notice that the moves from here will be more on a 25 cadence. Another 2 moves again in terms of rate cuts by the end of this year. What that does, of course, is that it takes away a little bit of the exuberance in terms of the rate easing cycle. But I think that's only natural to the point that I made a few minutes ago regarding the strength of the US economy. The stronger US economy, or the continued strength of the US economy, the continued strength of the labor market, and also in certain instances, particularly around core inflation, still quite sticky core inflation, would suggest here a slightly more sort of cautious bias by the Fed. And let's not forget that irrespective of which party actually wins the election coming up, of course, in a week or so's time, we are left with both parties signaling fiscal expenditure and fiscal spending and fiscal expansion ahead, all of which, of course, is going to put pressure in terms of yields. So that trend is probably going to be ongoing. Where it goes from here, I think there's a capped upside on yields, but yields are repricing. Those big rate cuts are not coming. Those more measured cadence of cuts are coming.